what I'll try to focus on is on EM currencies and EM rates, because quite frankly, from a risk premium perspective, that is where, in my opinion, much of the alpha can be generated in our asset class. And so with that in mind, let's just take a step back and look at where we are. Risk premium remains compressed across nearly all asset classes. I mean, if you look at equity volatility in both EM and developed markets, we're at March 2020 lows already. G7 currency vol, we're at 12-month lows. Credit spreads are now at post-pandemic tights. And on a relative basis, EM currency volatility is trading at a 20-year wide to G7 currency vol. All right, now suppression of G7 currency vol is the primary driver of this. But what it really kind of points to is if you look at indicators such as fear premia implied to historical volatility ratios or risk reversals, they're really indicating less of a demand for dollar protection. And in this world, I like to take what the market gives you. And when the market skews to the point where it becomes where you basically get paid to protect against a rise in the dollar, then you take that all day long. So effectively, we would probably be fading much of the recent move in EM currencies, just because, there's probably time for a tactical retrace, and seasonals appear, historically are weak. But nevertheless, demand for carry remains tested by low yields, inflationary pressure, and this risk on sentiment that we're seeing here in the post-pandemic period. I think the primary risk, and we get this question a lot, facing emerging market investors is the risk overhang from the U.S. Rates complex, right? So Fed tapering, the ensuing impact on risk premia is the primary risk facing the emerging market asset class. So that Chair Powell went to great lengths trying to assure the markets that the FOMC has not shifted in a hawkish direction, and tapering is still some months away. But rest assured, we're going to probably get some news ahead of the Jackson Hole Economic Symposium in August. I think summer payrolls are going to dictate the course of the Fed communique between now and then. And so by the time the Fed's ready to taper, where are we going to be? We estimate pandemic era quant easing will total $3.7 trillion, approaching the combined $3.9 trillion of the three previous rounds. And that means the Fed will have more than doubled its balance sheet from pre-pandemic levels to $9 trillion. It's going to take nearly a decade for the tapering to kind of get us back to where we were before the pandemic. So, clearly there's a lot of liquidity in the system, but what we're witnessing here is an asynchronous global recovery. And, the economic momentum across emerging markets is relatively uneven. And by that, we can see all the evidence in the PMI data, which is now rolling over in Asia. We see, PMI data in the CE3, Hungary, the Czech Republic, and Poland, not really living up to expectations. Same goes in South Africa. So, the pandemic is still with us, and the vaccine uptake in many of these markets has just not been fantastic. And so, we expect, the priority for central banks, despite what you're seeing on the inflation front, to remain focused on growth. And so if you look at swap markets and what the markets are pricing in terms of rate hikes across emerging markets, I think the smart money now is effectively trying to take advantage by fading that and by receiving in the front end of many of these markets, specifically countries like Brazil and South Africa, where you can get a lot more carry, as well as other places like Poland and Korea and India to a lesser extent, but maybe even moving out along the curve a little bit. But with China PPI likely to hit 8.5% year over year this evening when they release, that's going to be the highest print in a decade, effectively. So clearly, industrial metals, ag, and food prices are driving that, and the big question is, will that be transitory? I'm not so sure, I can't say either way. I mean, clearly, if you speak to people who are far smarter than I, they'll tell you that this inflation uptick is basically peaking in May, specifically for emerging markets. But, it's going to be very difficult to meet the demand of recovering economies in developed markets when supply is constrained by the pandemic. And so, I definitely think inflation can be a little stickier than we've seen in past episodes. And that's certainly a risk. And it's one that you might want to take advantage of or get in front of by receiving in the front end of many of these curves, because swap markets have really priced in quite a bit here. Just taking you through the whole of central, of where we are with emerging market central banks. I mean, Brazil just hiked, Russia hiked, South Africa shifted to neutral. The CE3, they're shifting to a more hawkish stance, and you're seeing the currencies for all of those countries leading on a year-to-date basis. So it just tells you what the market is looking for. And it's much in the same way the markets reacted post 2008 global financial crisis. It was the central banks that got ahead of the curve that saw their currencies appreciate the most. And I think you're going to probably see a similar outcome this time around. You know, in this world of lower for longer yields, what does this mean? What can you do to make money in a bear market for bonds? You can move down in duration. You know, Walter spoke to that. You know, taking advantage of EM corporate credit, you know, because it's got a lower duration. I can tell you this, EM high yield corporate credit is the most attractive asset class on a relative basis, and that includes securitized treasuries, global, developed, emerging, you name it. So, you know, there's a lot of premia to be extracted in EM corporate credit, specifically on the high yield front, for sure. And we do believe crossover investors rather are going to, you know, continue to look to take advantage of that. You know, one area, you know, so again, moving down in duration. The other one is to look for opportunities in high yield to move down in quality, but we've seen a lot of that take place already. You mentioned on the previous panel, African and taking advantage of the higher yields out along the frontier and EM sovereign dollar credits, but a lot of that is kind of been baked in to spread premium, in our opinion. And then finally, and this is where I really want to focus the rest of my conversation here, is you look for opportunities in non-dollar debt. You look for opportunities offshore in other currencies. Currency premium. If you're a rates trader in today's day and age, you need to be focused on. You really need to be a currency trader, and you need to be focused on FX premium. And so, you know, the area that we're focused, most of our research in recent months is on how to extract carry value and trend from EM currencies. I'm not going to go into that today. I'm going to, you know, basically leave that for a later stage. Please feel free to reach out to me if you have any questions about that research. But, you know, for the most part, I think, you know, what you're going to find is that, you know, if you're a rates trader, if you're looking to invest in fixed income asset classes offshore in non-dollar or non-euro or non-G7 markets, you know, you're really going to be taking, you're making an FX bet. You really need to understand what that means. You need to understand how to actively manage your FX exposure, which is why, you know, quite frankly, EM local debt's been out of favor for the past 3 years. I mean, we've had zero inflows into EM local bond ETFs over the last 3 years versus nearly 10 billion into EM dollar credit. So that just shows that you need to have an active approach.